Hey guys, Freaky Finance here. So I'm going to start adding a little 1 to 2 minute update each morning or each video about the market for each week regarding my overarching macro thoughts. My overarching ideas are what they were back in late June when this channel started, and actually they predate that, but it's really a reflation or stagflationary expectation, and that's kind of starting to play out, as you can see, in a variety of assets. And what that means is that I'm trying to find assets that would do well in that type of environment. Assets would be just general commodities, gold, real estate, so the hard physical assets generally do well and hold their value well. That being said, by extension, there are some equities whose underlying assets actually create the bulk of the value anyway, so some equities can also play into because they're playing on physical assets, assuming the debtors are stated. So I just wanted to share that current backdrop mindset before I dive into today's stock, which is Teck Resources. I kind of had to do this company after doing Suncor last week. They're partners in Fort Hills out in Fort McMurray. And as a heads up, I haven't put a bid into that Suncor after that video. But thinking about it after that opportunity late last week, it was about to print under $20 a share, which was interesting. And I might actually show an oil company some love, which is saying something, given oil's been a hell of a place to try to make money pretty much since, I want to say, 2016. Anyway, back to Teck, a commodity play. So Teck, this is the map of its operations, really has coal in Canada, and that's predominantly, I want to say, 50% of its revenue, maybe a little bit less than that now. It's steelmaking coal, to be clear, not thermal coal. And specifically, steelmaking coal is Elkview. So Cardinal River is closed pretty much, and all these are in the same kind of area. What else is there? Copper. So copper is primarily, I said this is in 3 of them, I want to say it's mainly South American from a production standpoint. They're currently expanding this Quebrada Blanca phase 2. It's kind of where Teck Resources has been putting a lot of its capital expenditures, as well as into Fort Hills, which I'll talk about in a bit with regard to energy. But right now, they're trying to push a lot of capital into copper to help further diversify its offerings. So Teck Resources, for those that don't know, is a diversified miner. Really, it has 4 outputs. So steelmaking coal is the primary one, copper is the next one, zinc is the third one, and they're starting to get into energy, I want to say, in 2018, halfway through there. So 4 primary offerings. So it's classified as a diversified miner. In zinc operations, it has 1 in Alaska. Pretty sure that's this one. Red Dog. Couldn't remember the name, but yeah. That's 1 in Alaska. So that's its operations. Its energy, 2 sites. It's tried to diversify oil at a fairly bad time in hindsight. But yeah, that's Teck. That's where its asset base are. How it splits out, as you can see, for 2019 anyways, pre-COVID. Steelmaking coal, 46% of revenue, but 58% of gross margin. So they make the bulk of their profit from coal still, and technically must have higher margins than the other assets, which it does, right? Copper is 21% of revenue, but 22% of gross profit. Zinc, 25% of revenue, 17% of gross profit. So that's its primary offerings. So just some differences between coal, what you're thinking about, and steel making coal, because most people think coal, they think thermal heating, because that's what we can relate to more readily. And I think it's about 70% of the market still is how they make steel is through coking coal. So many people just think, oh, thermal coal's going in the tank, right? And now gas replace it. It's pretty much been declining coal for a long time. But we still need steel. That's just something to keep in your back of your mind, because when you think coal, the first response is yikes. But there's something to say here for steelmaking coal. Additionally, the mines are very long-term in nature, so they last a long time. This means the depreciation and depletion that you'll see on the income statement are lower than what you'd expect for the asset class, for say a traditional mine like a gold mine. Just some things to keep in your back of your head as we go through this. Before I jump into the numbers, I just want to show what happened during the COVID quarter. Well, really 6 months worth, but this is 3 months. You can see the decline year over year for all its offerings. So while it's a diversified miner, when the commodities move in lockstep, you're going to get smacked. And some move more than others, and some have bounced back since then. Steel making coal, you can see dropped 37% year over year. Copper Price dropped 12% year over year. This is realized prices by the company, not the actual price of the commodity market in general. And then zinc as well, 30%. The main one here is bitumen. So they realized less than $14 barrel versus 51 in the prior year. So that's a huge drop, 73%. And I want to point this out because it's kind of interesting. I looked at Suncor last week, and their quarter, it wasn't great, but their realized price was about 27. You contrast that to 14. You can see there's some value chain for Suncor that's different downstream offerings with gas, really, and distillate. Let's jump into the numbers. So let's start annual, and you can see here, first off the bat, steelmaking coal is still the predominant revenue generator. Revenue was declining pre-COVID. The commodity price was actually under pressure pre-COVID as well. Actually, all of them were. Zinc was also trending lower. You can see that going from 3.5 million to 3.5 billion to 3 billion. And energy, which is a green here, in this case for revenue generation anyway, you can see 2018 had half of the Fort Hills. Trend is positive. It's diversified oil. It hasn't really worked out as planned. I think their timing's a little. I mean, they can't control that, but it's unfortunate for a company that's trying to break away from its coal background, or at least diversify some of that risk away. I do want to point out here they don't break out the depreciation on their income statement. So COGS includes depreciation, which is not cash, obviously. When I'm looking at cash flow purposes for anything in COVID, that's kind of what I'm going for, which is why I always break out the CFO. So you can see GMD is down 1.3 billion going into COVID. So not great. The main thing here, that's why I was saying their energy time is a little bit off. They had an impairment charge of 2.7 billion. They actually break out what it is. 1.2 billion Fort Hills write down, 1.1 billion from the Frontier write down. So these are both energy write downs. So those are pretty big for the company. I mean, when I look at their PPE, net book value, and cash and AR and inventory, you can see that they're still a $37 billion assets. So on the books, so well, 3 billion or 2.5 sucks. For a write down, it's not the end of the world. They do have a lot of assets. So, and obviously the impairment's non-cash. What else is there? You can see that operating income went from 4.8 billion to minus 150,000. I mean, we just went over the impairments, 2.7 billion of that, but still, without it, it would have been 1.3 billion less anyway, just from a gross margin standpoint. So, not a great trend going into COVID. Its capex is also pretty high, and it actually went up in 2019 while the underlying business fundamentals went down. And you can see the share price reflect that. In 2019 went down quite a bit. That's at December 31st price. They were still doing buybacks going into this as well. So the market cap actually went from 16.7 billion to 12.2. So I always highlight it in green because I view that as an opportunity. I'll go to the next, what it's currently worth in the next slide, or the next tab. They were actually paying down their debt, which is good going into this. And their total debt did increase though, so their bank indebtedness, I should say, went down. So they retained the bank back principal. Their total debt actually increased though because provisions as well as QB2 advances. So that's that South America, Chile copper play that I'm going to talk about a little bit more in the quarterly. You can see the cash flow from operations less the capex is pretty much took out all the free cash flow. So it's pretty much 2019 invested almost everything it made in cash flow from operations into the business again. And I think that just shows that it's trying to just push into copper, push into anything else that isn't coal right now to help diversify the offerings of the company. That makes strategic sense, but the timing sucks. GM percent, you can see the decline. That's not in the company's power. That's literally the commodity market was dropping for a lot of its offerings at the same time. Market capitalized of a CFO, actually a little bit cheaper than it was in 2018. That's because the market price fell. But from a free cash flow perspective, it got spanked in 2019. So anyway, quarterly, it's a similar story, but worse. So, and this could be one of the worst quarters for Teck, or Q3 might be, but it shows just the pressure in the commodities. So, like that price decline in the commodity markets year over year, right? You can see revenue decline 50% for copper, for coal, almost 40% for copper, 20% for zinc, and 85% for energy, right? So, big decline in revenue, and it wasn't offset by COGS enough. So, sorry. I mean, COGS only went down 400 million, but the revenue, revenue alone, 800 million delta here, 200 million delta here, 130 million delta here, another $250 million delta there. And the SGA did go down, so it shows that they're trying to cut back, but I mean, when their COGS are the predominant cost source, SG is pretty small in comparison, right? I also thought this was interesting. They didn't impair any further assets, even though the commodity market got smoked, so I'd treat that as they already assumed that they impaired enough already. It's a risky assumption. I actually think they should have impaired something. And the quarter was already bad based on the commodity price. You can't really just say, oh yeah, no, our assets aren't impaired. Unless they say they already impaired it. But you see other expense spike up, which is unfortunate, and that's the COVID costs. So not only did the commodity market go down, but they had extra costs from COVID. And that isn't just a Teck Resources thing. That's almost every single income statement I looked at for Q2 had extra costs from COVID. I want to say every single one actually did. And it's nice when they break it out like this. And 60 million more was from environmental costs. I'm going to talk about that at the very end. There's an environmental risk here with the coal projects in BC, British Columbia. And you can see the net income reflected in our line performance from the revenue drop. Really a GMD drop. I mean, it went down virtually 90%. So the quarter wasn't great. The share price reflected that. It dropped down 50%, closed at 15.35 I think yesterday. The price has started coming back a bit. It's rallying a little bit with underlying commodity markets, specifically copper has been having a bit of a run, and that's what you'd expect in a reflationary environment. The market cap went down from 16 and a bit, almost 17 billion. Now it's worth about 8.1 billion from the equity component standpoint. So it's about 50% cheaper. When I looked at the asset base, cash is 700 million less than it was a year ago. PPE did increase, so I mean that's just reflecting CapEx expenditure in Chile, trying to expand more and more into copper. Bank indebtedness actually reversed its trend, which is unfortunate, but it makes sense because it had to. So fill the money from somewhere when their operations declined so much, right? So debt increased 1.2 billion year over year. However, the total liabilities didn't shoot up that much because the AP, well, when you have less business, you have less suppliers. So that's just a function of that. And cash flow, you can see the big drop. And that's in line with the GMD drop. I mean, it's a delta of 800 million. It's a large percent. However, this is what I want to point out. Unlike, say, Suncor, which cut its capex and cut quite a bit of other things, including this SGA, Teck actually sped up and accelerated its capex in Q2 on declining CFO, or cash flow from operations. So now you can see that shortfall, and that's financed by debt. The GMD, or GM percent, sorry, decline. That's the commodity environment. You saw those sharp declines across the board. SGA fairly unchanged, and well, the market cap went down 50%. The cash flow from operations went down about 80% or 90%. So based on Q2 results, the company still isn't as cheap as it was, even though it's already down 50%. Obviously, it's the worst case scenario. I normalize the cash flow, so it's not reflective of the company for a whole year unless this continues for a whole year. So, but it's something to remind yourself. It's cheap, but it's cheap for a reason. Here, I just want to show, this is just on their presentation slide deck. You can see the proceeds. So that's what they issued debt, 888 million in the quarter, and pretty much virtually most of it went back into the business and PPE. So it took out some debt and expanded more into Chile. That's pretty much what these two columns are. The debt was actually pretty good. So, and most companies have had access. What I mean by good, I mean the interest rate was low. Like it wasn't a Carnival Cruise Line 11% yielding bond. This was a 3.9% note due 2030, so a fair maturity schedule. And you can see its debt schedule isn't that bad. It doesn't have that much due in the next 3 years. And that's important to keep in your back of your mind for liquidity reasons. The interest rate's good and the maturity schedule's good. So from a financing perspective, it actually looks pretty great. I mean, it got a cheaper rate than what it has on other ones, albeit these ones have a lot farther maturity. But so fairly good on the debt side. I mean, it sucks that they have to increase the debt, but when you have no operations from cash flow and you're trying to expand, that's what happens. So to conclude, my thinking is the balance sheet decisions made by Teck management during the COVID quarter has given the team time to ride out the commodity environment. That being said, they haven't been as successful in getting their capex or operating costs in line with the current COVID fundamentals, like say Suncor did when I went over that last week with you guys. The CFO less capex was negative 500 million in the quarter, even if Teck keeps on taking pretty cheap debt. I mean, 3.9% in the next 10 years is great, but I mean, you're still going to have to pay that back, and you're still going to pay more interest every year. It does have a lot of room to take on more debt, but I mean, it doesn't help the shareholders any. It just helps bridge the gap. Ultimately, if coal goes up to the, say, $150 US per ton from the 114 US per ton that I realized in this quarter, the CFO situation will improve materially. though it looked like Teck realized 187 US dollars per ton just a year ago. So I won't be 2019 numbers per se, but it'll be somewhere in the middle. The recent copper uptrend should help Teck in Q3, Q4 with its cash flow from operations, but copper traditionally is only about 22% of GMD. Even if it does shoot up, it's not the huge driver. It is a driver, it's the second biggest driver, but it's not the primary driver. If the commodity market continues in this range, Teck will have to either cut capex to continue to finance the CFO shortage, or plug it up with debt, right? Or probably both. That being said, capex is higher as it tries to push QB2 through, and that will help capture the copper upside and further diversify from coal. Given it was able to get that 3.9% 10-year maturity, I would think it would be easier just to raise debt than stop upgrades and expansions, as it seems to be cheaper than the existing debt interest rates that it has on its maturity schedule. And that's a unique COVID thing, I believe, is when the company is technically less fundamentally secure but can get cheaper debt, whereas say anybody else, if I was to try to get a loan and all of a sudden my income was slashed by 50%, they would not give me a cheaper interest on my loan. Or they shouldn't, because I am technically a more riskier client. But for Teck Resources and for almost every large cap company, they can issue debt at cheaper rates than what they currently were able to get pre-COVID, which is unique. Overall, I'm not as confident in saying this is a buy as I was for Suncor. So Suncor is kind of on the fence, and I'm looking at it. I still haven't put a bid in, but Suncor I'm more confident in because I think I have better insight in what the energy markets will be, and if I'm wrong, Suncor has the ability to go up and down the value chain itself, right? The bull case is the cheap debt should enable Teck to ride out COVID and partake in the anticipated commodity increase for its products, and that would likely continue to be reflected in the share price as it tends to correlate with its commodity offering prices. But it does rely on access to debt and its line of credit in the interim, so there's a risk there, say if commodity prices just linger and they don't reflate or stagflate up. Given that the continued trillion-dollar packages are likely in the US, as the more pain is felt, the more likely it happens. So if the stock market goes down by X%, you're going to see a $1 trillion package right away, or at least that's my view. It follows there should be continued upward pressure on the commodities in light of that, helping to reinforce the commodity price, and may not allow for much of a pullback in those commodity prices. So that's why I'm thinking Q2 might have been the worst possible, but don't quote me on that. Q3 could be just as bad. But over time, I do expect the commodity prices to come back. They seem, like on their call I listened to before I came on, they seem positive on their QB2 copper upgrade. Which management team wouldn't? But right now, it appears COVID has thrown a wrench in their plans. Though they're still going through with the plans by bridging the cash flow operation shortfall with the debt, but they're just, it's bad timing when you have to do such a big upgrade and COVID happens, right? It's like, But anyway, to conclude my thoughts, the pollution at Elk Valley for their 4 coal mines is another risk. And if the BC government or environmentalists were ever to try to really halt production, this investment would react sharply, given how critical coal still is to the organization. With that in mind, Teck has worked with the BC government for quite some time and is incurring environmental costs already. This environmental threat is nothing new. If you're an investor in Teck, you should be very aware that that is a threat, and it's a binary threat, right? So that will materially impact the stock. If the Biden plan in the United States, say if he's elected in November, and the world tries to continue its acceleration off coal, which is where the world is probably going anyway, and as an aside, not sure if there would be an increased scrutiny from the US on the BC coal mines, given where the river flows. So say if Biden's elected, does this put more pressure on the coal mine industry in Canada? And I think it does. So that's another thing I need to be aware of. So because of that, I need more price margin of safety. So I'm not going to buy at 15 right now. I'd probably wait for Q3 numbers just to be like, okay, is this starting to normalize and reverse? It might suck because, say, if it goes from 15 to 17, I miss out. But if they come back to where they were, this is a potentially be a $25 stock or a $21 stock or something like that, right? So I can still get that upside without taking a big risk, because I don't know. There's so much political risk right now, and coal isn't exactly a precious metal. Anyway, those are my thoughts on Teck Resources. So I'm not going to put a buy into this one right now. I'm going to keep looking at it. It's what I do. And hopefully with more information on the next quarter, I can make a better decision. But right now, I'm going to keep watching it. I mean, if it pulls back materially, I'm going to revisit it like I would with anything. But at this time, based on all the current information, I'm not going to buy into this stock right now. All right, so with that in mind, hope you guys have a great weekend, and I'll talk to you next week.